Good morning, ladies and gentlemen, and thank you for making time to attend this webinar this chilly morning. On behalf of my partners and the staff of PKF, we take the pleasure to have you on board. I will be joined by 3 panelists to discuss the Finance Bill 2023. That is Mr. Salim Haribai, our partner in the audit department, Mr. Kevin Chege, Senior Tax Manager with PKF, and Mr. James Mulili, Tax Director with PKF. So I will begin this discussion by, highlighting a few salient issues that have happened in the last 1 year. And one of them is definitely, you are very aware that the budget for this year is about 3.6 trillion shillings. This is an increase from about 3.2 trillion in the previous year. This obviously puts a strain at the government in terms of raising finances, whether by borrowing or whether it's going to be by tax revenues. Whichever way you look at it, this is going to put a lot of pressure on government. And the question that we will be discussing is how the tax proposals that are contained in the finance bill are going to impact the business community whilst the government is trying to raise these funds. Starting close to Kenya, we have witnessed quite a number of challenges, and listening to the government, to the National Treasury, to the President, everybody is talking about the challenges in the headroom for further borrowing. Whether locally or internationally, it is becoming untenable for the country to borrow more money, and therefore the focus is likely to be finance government activities through taxes. Now, what's the impact of raising taxes vis-a-vis expanding the tax base? The Finance Bill 2023 seems to focus a lot more on increasing taxes, but tribute to the Treasury, they equally put in place mechanisms for expanding the tax base. And we have seen things that have been proposed, for example, 24-hour remittance of certain taxes, like the betting taxes and all that, and expansion of the withholding tax regime for purposes of recruiting, taxpayers. And therefore, we expect that the KRA will have a lot of action in terms of enforcement. And this is likely to put pressure to the business community in terms of compliance. The bill also proposes significant incremental taxes on the middle class. For example, the introduction of 35% tax on anybody earning more than 500,000 shillings a month. Now, what is the impact of this? The middle class in any economy is actually the engine of the economy. They are the people who through spending, who through consumption, really drive the economy. For example, if you take a person earning about 1.5 million Kenya shillings a month, it means that person will pay 50,000 shillings more to government because of the 5% incremental tax. What this means is that 50,000 shillings is actually not available for consumption or for expenditure by that person. These are the people who will spend this money in restaurants, in entertainment joints, in luxury stuff, because the middle class all over the world is known to be the one that drives consumption. What is the bigger impact of that? The bigger impact is very simple. That one waiter who is employed in a restaurant will no longer be there because the middle class will not be having that money to spend. And that goes for many other sectors. So it has an impact, and we really hope that the government has got very carefully before perhaps, focusing on really milking the middle class, because these are the people really who pay a lot. On the global stage, we have equally a lot of challenges. One of the main challenges we have seen for all the countries is foreign exchange. You've seen countries like in India focusing on trading in rupees. Obviously, the Russians have insisted on people buying petroleum from them using the ruble. You have seen the Kenyan government lately focusing on importing petroleum products on a regime that is going to be Kenya shilling based. So this is going to put pressure on economies the world over for some time. There is no exact answer to it. And obviously, you can see the government is also reacting in terms of trying to expand the tax base, increasing the taxes to be able to put in for that shortfall. Global politics, the war in Ukraine and what's happening in Russia and the geopolitics around it will continue to impact the economy for some time. And this is also putting pressure, not just on the Kenyan economy, but the whole of Africa as a matter of course. In terms of governments funding their budgets, this is a problem the world over. It's not a Kenyan problem. Very recently, you've seen the Ghanaian government actually come up and say they cannot meet their debt obligations. South Africa struggling in power, and many countries, including the US, governments are having to borrow to finance their activities as opposed to really going back and overtaxing the people. Closer home in Kenya, some of the tax measures that this team is going to be discussing with you, the most impactful is the intention to reintroduce VAT at 16% on petroleum products. James is going to be discussing with you the anomaly in the VAT in the bill, where the intention is actually to return petroleum products at 16% VAT, but it seems the drafting was not properly done. It suggests that for the moment that is intended to be under the exempt category. The most other radical proposal is that now if you are fighting with the KRA beyond the tax appeals tribunal, that means appeal to the High Court and beyond, you have to put 20% deposit on the tax that is disputed for you to be able to seek justice. This is a very radical measure. You remember it was intended to be introduced last year and Parliament shut it down. And when the TAT Act was enacted in 2015, there was a proposal again for 50% deposit. Parliament, in their wisdom, found it that this infringes actually Article 48 of the Constitution because it impedes access to justice. We truly hope that Parliament will live to the expectation and also shoot down this proposal, because the impact is really to give the government or the KRA an unfair advantage in our contest. So we will wait to see what Parliament does on this. Other radical changes proposed: 24-hour remittance of taxes for people in the betting industry, and a 3-day window to remit taxes if you are in the withholding VAT regime category. So the moment you collect, you expect them to pay within 3 days. The impact of this obviously is that it's going to put pressure on people who are withholding VAT agents in terms of really having someone to sit and remit this tax almost on a daily basis, because it's not timed, for example, on the 20th, like we've always done, but it's 3 days after you receive every payment. So this is going to put a lot of administrative pressure on companies to ensure that they comply with this. In terms of really what to expect out of this finance bill, the KRA is really going to come hand on businesses. And I think the government has made this intention clear. I mean, from the top leadership, it's very clear that tax is going to drive the financing of government activities, and therefore we expect that the KRA will be at the center stage of this. The government also seems to be taking an overdrive here in terms of data-driven tax collection strategies, putting people on automated platforms, including intention to put rental income on automated platforms. So we expect a lot of changes around the e-teams. Remember last year, government implemented the teams system. That has now been upgraded, and they are already piloting the process for implementation on the e-teams. So this is again going to cost a little bit for people to translate from teams to e-teams. General taxes, we expect this to increase, looking at the very many proposals that the team will be discussing. Now, what is the journey for this bill to become an act of Parliament? You have up to 20th of May 2023. You can table your views to the National Assembly through the relevant committee of Parliament, and these views are expected to be taken into account for members of Parliament to enact that bill and to have it assented by the President no more than 30th of June 2023, and it becomes effective 1st of July. Some of those clauses become effective at various other dates, but most of them become effective beginning 1st of July 2023. You will also remember we have the East Africa Community taxes, which are governed under the East Africa Community Customs Management Act. This will equally become effective 1st of July 2023, and we expect before then that a gazette notice will have been issued so that we can see what changes are proposed for customs. With those very few remarks, I now wish to invite Kevin to take us through the first section of the changes.
Thank you very much, Michael, and good morning to our listeners and viewers at large. Just welcome you once more to this webinar. My name is Kevin Chege, as Michael has introduced, and I'll be taking us through the proposed changes to the Income Tax Act, as well as the proposed changes to the Tax Procedures Act, which is the main statute that provides for administration of various tax statutes. On the Income Tax Act, we are going to look at various changes that will affect the corporation tax rate or the corporation taxes. We are going to look at changes to the withholding tax regime, some few changes to the PAYE taxes that are paid on a monthly basis, and we'll also look at some changes that have been proposed to be made, the CGT or the capital gains taxes. So without further ado, I want us to dive in. And I think Michael mentioned about the government digging into taxpayers' pockets, and some may have a concern. Is it digging, or is it a hole that is being sunk and emptying into the exchequer's account? Now, the first proposal, which I know affects so many taxpayers in this forum and beyond, was a proposal that was introduced, or a provision that was introduced through the Finance Act of 2021, requiring restriction of interest to the extent of 30% EBITDA. I know some of you have already experienced this and have seen how detrimental it is to businesses. Now, the bill has proposed to make some changes to this provision, and this is how it will look like. Currently, both interest restriction and for realized foreign exchange losses deferment is based on 30% EBITDA. That will still be the case, but what will be the change? Now, when we come to interest restriction, the bill proposes that the interest to be restricted will only be that portion of interest related to foreign loans. Now, when you restrict that interest, you restrict it to the extent of 30% of EBITDA. So you are allowed to claim up to 30% of your EBITDA. What will happen to that restricted amount? The bill proposes that that restricted amount can be claimed in the subsequent 3 years, provided that in those 3 years, you don't also breach the 30% EBITDA. So that is the change that is proposed in the bill in relation to interest restriction. FX losses, the bill proposes that for FX losses, you will defer them if your interest exceeds 30% of the EBITDA. So you will not bring the realized FX losses in that year. However, the bill also proposes that FX loss that you have not claimed, you will be allowed to claim it over a period of not more than 3 years from the first year of deferment. So that is the change in relation to interest restriction. I think the main issue would be the restriction will now be based on foreign loans and not on local loans. There's also a proposal whereby some entities had been exempted from the EBITDA restriction provision, which were involved in manufacturing and had a cumulative investment of more than 5 billion. So the bill proposes to scrap that provision, more or less to introduce a level playing ground on all taxpayers. The next proposal that is in the Income Tax Act is an introduction of a new tax to be called a digital asset tax. The government has noticed that people are engaging in trading of cryptocurrencies and they want to tap into that avenue for taxes. So digital asset tax will be levied on the transfer value of any digital asset, and digital assets includes the normal digital assets as we know them, including cryptocurrencies, non-fungible tokens, and so forth. So when you make that transfer, and that income has been derived or accrued in Kenya or through a platform that is based in Kenya, you'll be required to pay a tax of 3% on the transfer value rather than on the gains. So that's a departure from how we know the levying of income taxes, which is beyond the transfer value. That tax will be remitted to the commissioner within 24 hours, and it will be remitted by both resident persons and non-resident persons. So for non-resident persons, they will be required to register under the simplified framework of registration. So that is as far as the introduction of digital asset tax. And for those who are actively trading in cryptocurrencies and the likes, please know that the government will demand tax from those considerations or transfers made. Now, moving on, there is a proposal to change the threshold of turnover tax. Turnover tax was a tax regime that was introduced mainly for small and micro enterprises, and currently it's levied on at a rate of 1% for businesses that have a turnover of between 1 million and 50 million shillings. So the bill proposes to reduce this threshold to between 500,000 shillings and 15 million shillings turnover, but at the same time increase the rate from 1% to 3%. So ultimately, what it means is that if your turnover exceeds 15 million shillings, then you automatically graduate to the 30% tax bracket. Changes regarding withholding taxes. If you can recall, through the Tax Rules Amendment Act 2020, there was an introduction of withholding tax on sales, marketing, and promotion services paid to non-resident persons at the rate of 20%. The bill now proposes to roll over that to cover resident persons, but at a lower rate of 5%. Another change that has brought about a lot of debate is on digital content creators, or as people may put it, the people who are doing social influencing, social marketing, and digital content creation, also influencers, as people call them. So the government has realized that the marketing model has moved from the mainstream marketing as we used to know it, and it's now more on content creators. You know them, we see them on a regular basis. So the government intends to introduce a 15% withholding tax on any payments made to residents in relation to digital content creation, and the 15% will be levied to the government within 24 hours after deduction. Quite a controversial amendment, because 15% withholding tax ultimately means that these people will be having margins of over 50%. But if you look at the spirit of those who drafted this provision, they know that the recipients of this amount may not account for the full amount, and the 15% may end up being a final tax. Another proposal that we have various or significant implications involves where the commissioner will have powers to appoint property agents who collect rental income on behalf of the landlord to be able to withhold tax on those collections and remit that to the KRA. Now, there is also a proposal to lower the withholding tax rate on rental income from the current 10% to 7.5%. So if a person is collecting rent on behalf of a landlord, it will be required, before you remit the amount to the landlord, you withhold 7.5% and remit the same to the KRA within 24 hours. The question that arises here is, will this also be rolled over to individuals who are under the monthly rental income tax? And the other question would be, what happens if both the landlord, both the tenants and the property agent are appointed withholding tax agent on the rent? Then the landlord will end up being in a perpetual credit position. So there needs to be clarity on the implementation of this provision, but the bigger goal is that KRA wants to get into the tax net of landlords who collect rental income but don't declare the same for taxes. Some changes in relation to the tax deductibility of various expenses, and the bill proposes that upon assent, you will not be able to claim as an expense any expenses or losses that are not from an e-TIMS compliant invoices. Of course, there are certain exemptions to this. Things to do like payments for salaries will not be subjected to this. Interest invoices or invoices on interest expense, investment deductions, and at the same time, anything to do with importation of products will not be in this bracket. But what the government is really telling us is that going forward, all taxpayers will be required to be e-TIMS compliant or to roll over implementation of e-TIMS in their businesses. A change in relation to how KRA carries on audits and purchase adjustments. So the bill proposes that in the event of an audit and the KRA disallow any amount that had been paid to a non-resident person where withholding tax had been deducted, then the KRA is saying that withholding tax, they will keep it, and at the same time, they will disallow the expense that had been paid out. Ordinarily, how it has happened is that if KRA disallow that amount, they used to give you a credit for the withholding tax paid because it's on the same income. Now, what the government is trying to do is more of having its cake and eating it to the extent that they keep the withholding tax and they disallow the expense in its entirety. Such a retrogressive provision that we hope will not see the light of the day or will pass with various amendments. Capital gains tax, there are some various proposals that have been made in the Finance Bill 2023. The first one was to try and widen the scope of transactions that are subjected to capital gains tax. We have seen in scenarios or instances in the past where a transfer happens out there between two non-resident persons, but it relates to an underlying asset or property that is in the country, such that you have several layers of companies. You transfer the shares of the holding company, but the holding company really does not have any substance. It's holding the shares in a subsidiary in Kenya, and the value of that company or the holding company, it is derived from the company that is locally incorporated. So the finance bill aims to cure that loophole and provide that if 20% of the underlying asset is held directly or indirectly to an immovable property located in Kenya, then capital gains tax will be levied on such transaction. The next proposal in relation to capital gains tax would be to limit the misuse of various exemptions that have been provided for capital gains tax. The first one is a scenario where you would undertake a transfer which is exempt from CGT. Then you wait for a period of 3 years, of course, to ensure that you are not caught under Section 23 of the income tax, which is a general anti-avoidance provision. Then after 3 years, you do a subsequent transfer, thereby avoiding paying a huge CGT amount based on the original cost of the immovable property. So what the government intends to do to cure this is that if you do a subsequent transfer within a period of not less than 5 years, then CGT will be levied on the difference between the original cost of the immovable property and the final transfer price. So that will cure that loophole that people have been using. I don't want to say to avoid tax, but for tax planning purposes. The other provision would involve transactions related to group restructuring are currently exempt from CGT. If you transfer an asset and that asset does not involve transfer to a third party, it is currently exempt from CGT. So we have seen instances where people incorporate companies just for the purpose of avoiding paying CGT. And what the government has noticed is that there's a huge revenue leakage from this provision. And what they intend to do is that if you do a group restructuring and you transfer an asset to an entity within the group that has not exceeded for more than 2 years, then CGT will be applicable on that transaction. There's also a proposal to widen the definition of immovable property, more or less to provide, to cast the net on all kinds of transactions involving immovable property to be subject to capital gains tax. Moving forward is that there's a proposed introduction of a new tax to be levied on intellectual property or preferential tax regimes. And preferential tax regimes have been defined in the Act to include entities that enjoy a lower tax rate than what is provided in the Act. This includes export processing zones, special economic zones, as well as entities that are incorporated in jurisdictions that have a tax rate of less than 20%. I don't want to dwell much into this because the provisions that are meant to provide for this tax seem missing in the bill. We hope that that will be rectified before the bill is amended so that we can see the bigger intention and how this tax will be levied. Another proposal would be in relation to taxation of branches or permanent establishments. as many people call them. Now, currently, the tax rate for a branch or a permanent establishment operating in Kenya is at the rate of that 7.5% on the gains of the branch or the permanent establishment. The bill proposes to reduce this rate from that 7.5% to 30%. However, that will not be the only change in relation to the taxation of branches. Currently, we don't have what is called a branch repatriation tax or any after-tax distributions by the branch to the head office. And the government wants to cast its net into that bracket. And what will happen is that any remittances by the branch to the head office will be taxed, but subject to a certain formula that has been given in the finance bill. And the formula will provide that what is going to be taxed will be the net change in assets and the difference between the accounting profit for the year and the tax payable by the branch. So it will be a function of the net assets or the change in net assets in the year and the difference between the tax paid by the branch and the accounting profit of the branch. So this, of course, the rate has not been provided, but we expect that branch repatriation tax will be deemed to be a dividend distribution by the branch to the head office, and it will be subsequent to the after-tax the distribution by the branch to the head office. There is also a provision to provide that certain expenses incurred by branches or head office that were earlier on allowable for tax purposes, to the extent that they incurred outside Kenya, they are currently allowable for tax purposes, but the bill proposes to repeal that and provide that such expenses will not be allowable for tax purposes. In relation to the second schedule, the Income Tax Act, there are some changes that have been proposed. Diminution of utensils and loose tools is currently allowed at the rate of 33 and 30%, or you're allowed to claim that over a period of 3 years. And the bill proposes to change that, to provide that you claim the full expense in the year incurred or at the rate of 100%. There is also a proposed reintroduction of industrial building allowance. It was there before the repeal of the second schedule. The bill proposes to introduce it at the rate of 10%. However, the bill does not provide this 10% will be at a reducing balance basis, and it will be spread equally over the life of the industrial building. I hope that provision will be provided before the bill is enacted into an act. There is also a proposal to incentivize infrastructure being undertaken at the port. So the introduction of allowances on docks, include certain infrastructure at the port, including jetties, terminal harbors, and so forth. So they will enjoy an investment or allowance of at the rate of 10%, spread equally over the life of over the amount that you have claimed. In 2020, when the second schedule was repealed, there was an introduction of an investment deduction at the rate of 100% for companies or entities that are located outside Nairobi and Mombasa counties and have a cumulative investment of over 2 billion shillings. There has been uncertainty on whether that relates to everyone, and the bill proposes to provide a clarity on that and provide that investment deduction at the rate of 100% will only be applicable to hotel buildings and buildings and machinery used for manufacture. So anyone else not in that category will not enjoy the 100% investment deduction for investments over 2 million shillings. There's also a proposal to provide that those investments should be located outside Nairobi and Mombasa counties by virtue of that they cannot, the nature of business requires them to be outside those counties. The implementation of that may be very subjective because some businesses will be outside Nairobi and Mombasa counties by virtue of not because they want to be out there, but where the space has been available. So those are the changes related to the second schedule of the Income Tax Act, touching on investment allowances. Some few changes related to corporation tax or the general corporation tax, and there's a proposal to introduce a 30% tax on members' clubs and trade associations on any other trade receipts apart from the income from subscription or entrance fees, apart from subscription or entrance fees, any welfare and any joining fees to be paid to those members' clubs and trade associations. So if a members' club or trade association engages in other trade, then the income of that members' club or trade association from that other trade, apart from the joining fee, the subscription, and contributions to welfare, will be subjected to income tax. Through the Finance Act 2023, there was introduction of tax exemption to trust income, where that income is being distributed from a registered trust, and it is used for the purpose of education or medical purposes, and that income does not exceed 10 million shillings in a year of income. So the bill proposes to repeal this exemption, and therefore any distributions from a registered trust for whatever use will be subjected to tax. In 2022, through the Finance Act of 2022, there was an introduction of exemption to companies that are engaged in the manufacture of human vaccines. They were exempted from paying corporation tax. That will be repealed if the bill goes through, but the bill provides that these companies, instead of paying of not paying any corporation tax, will pay corporation tax at the rate of 10%. There's also a provision where certain entities, especially those are included or involved in the promotion of religious activities or alleviation of poverty, are exempted from income tax provisions. Now, the government has noticed that there is quite a lot of abuse to that exemption, and they intend to provide clarity that if for you to qualify for that exemption, you have to demonstrate that that entity is registered in Kenya and it is administered in a transparent manner. And further to that, that entity has not been registered to confer a benefit to an individual. I think this, as you have all seen in the media, it's more to cover religious institutions that confer a benefit to an individual. So such entities will no longer be exempt to income tax exemption unless they demonstrate that they operated in a transparent manner and they do not confer a benefit to an individual. There have been some clarifications related to filing of country-by-country reporting by multinational enterprises that are tax resident in Kenya. And what the bill proposes to provide is that the entity that will be required to file the country-by-country report will be the ultimate parent entity, which is tax resident in Kenya and is part of that group that has a turnover of over 95 billion shillings in the preceding year of income. Currently, there is no clarity on the year of income to use when evaluating the 95 billion shillings threshold, and there is an uncertainty on which entity is supposed to file the country-by-country report. Subsequent to that, the bill has also provided that there are instances where an entity that is not the ultimate parent entity, so a constituent entity, this may be a branch or a subsidiary, which is part of a group that has a turnover of over 95 billion shillings in the preceding year, may be required to file a country-by-country report with the KRA, even if the ultimate parent entity is located outside Kenya. So those instances will include where the entity or the ultimate parent entity is not obligated to file a country-by-country report in its jurisdiction. Number two, if there is no competent authority agreement between Kenya and the jurisdiction of the ultimate parent entity, or there is what we call systemic failure in the jurisdiction of the ultimate parent entity. So those are welcome clarifications that will provide clarity on the filing of country-by-country reports by ultimate parent entities and constituent entities of multinational enterprises. There is also a proposal to provide clarity and introduce a preferential tax on the taxation of employee share ownership schemes. And this will be rolled over also to startups. We have seen an influx of startups in the country, and those startups are paying their employees, instead of giving them cash benefit or payments, they give them shares or a right to subscribe to the shares of the company. We need to encourage you to make for talent retention, and also for you to dedicate your time to the company. So the bill proposes to provide guidelines on how these ESOPs or startups will be taxed. And for the avoidance of doubt, a startup will include an entity that has not existed for more than 5 years, does not have a turnover of more than 100 million shillings, has not been formed as part of a restructuring of a group, and that entity ought not to be undertaking the trade of management or professional services. There is also a clarification on the current taxation of employee share ownership or plans, and where the bill seeks to clarify that the market value of that ESOP will be the value at the exercise date and not the value at the date of granting that option. So that's a welcome proposal, as it provides the much needed clarity on the value that will be subjected to tax in relation to ESOPs. A few changes related to the transition of employment taxes, all which will cover PAYE. And the bill, as Michael mentioned earlier on, proposes to introduce a super tax bracket of 35% on any income of over 6 million shillings in a year earned by an individual. And this translates to monthly income of over 500,000 shillings in a month will be subjected to a tax of 35%. Maybe tax the middle class and the high net income earners in the country. There is currently what we call owner-occupied interest, where you are allowed to claim as a deduction interest and to a maximum of 300,000 shillings on any interest paid to for owner-occupied property. The bill proposes to expand this scope to introduce any interest also paid to a mortgage refinance company. Previously, this is a new entity that are being incorporated to provide mortgage refinancing, and the government wants to ensure that payments made to those entities will also qualify for owner-occupied interest. There is also a proposed introduction of post-retirement medical fund relief to work just the same way as the relief on NHIF. So any payments made to that post-retirement medical fund on the lower of 15% of the deduction of 60,000 will be an allowed deduction for individuals computing their income taxes. There is also a proposal to peg the mileage claims on the specified areas. I think this has always been the scenario, only that it was not expressly provided in the law to peg those mileage claims on the EA rate. So any mileage claims above the EA rate will be a taxable benefit to the employee. There is also a very discriminating proposal where RDNs payable or paid to public officers will not be subjected to tax based on the provisions of the income tax, even if those RDNs exceed the value of 2,000 shillings as currently provided, or the RDNs are used by the employee to purchase any item that is for their personal benefit. That's a discriminating provision, because whereas employees in the private sector will be subjected to pay on any RDNs above 2,000 shillings that are not supportable, public officers, on the other hand, will not be subjected to this to tax on the same. Another, I would call it a cleanup, will provide that a wife's employment income will no longer be treated as a separate source of income. The Act provided that a husband may declare a wife's employment income as a separate source, but in this day and age, wives declare their income separately and pay their taxes separately. So it's more of a cleanup in the current scenario. Some few other changes related to corporation taxes, and there will be an introduction of a requirement that for companies that are engaged in petroleum industry or mining industry that are governed under the 9th schedule, if there is a movement of over 20% of the underlying ownership of the company, you'll need to notify the commissioner on the same. There is also a proposed widening of the definition of what entails winnings in terms of betting and gaming, and the bill proposes to provide that winnings will also include the amount staked by the punter or the person who is placing the bet. So I think, in my opinion, that's a retrogressive provision, because it intends to even subject to tax the amount that had been staked by the punter or the person who is placing a stake. There is also a proposal to up the advanced tax rates that are payable on companies that have motor vehicles from the current rates. Maybe this is just to cater for the increased inflationary pressures, and also for increased tax collections by the government. There is also a clarification on local assemblers of motor vehicles, where in 2021, the Finance Act provided that, or introduced a provision that local assemblers of motor vehicles would qualify for a 15% corporation tax rate, provided that they incur over 50% of their manufacture in local content. So there was that ambiguity on what really constitutes local content, and the bill proposes provide clarity there and provide that local content will include any items that are locally purchased or manufactured to the extent that they exceed over 50% value of those local assemblers of motor vehicles. Some few exemptions on payments that will not be subjected to income tax. Maybe this is more targeted to the new investors in the human vaccine manufacturing industry, and any payments for royalties made to an unregistered person who is involved in the manufacture of human vaccines will be exempt from income taxes or withholding taxes, and any interest payable by those entities on any loans payable to a resident or non-resident person will be exempt from income tax or withholding tax. So in a nutshell, those are the changes that will be effected to the Income Tax Act, and will have far-reaching implications in terms of the corporation tax paid by companies, the PAYE on individuals, the withholding taxes payable on qualifying payments, and any payments for capital gains tax. And with that, I would beg to move to the proposed changes in the Tax Procedures Act, which is the main statute that administers the application or the administration of the various tax statutes. Now, when you look at the Tax Procedures Act, there's a proposal in the Finance Bill of 2023 that any amnesty, or sorry, any penalties or interest that have been incurred up to the period of 31st December 2022, and the principal tax thereon had been paid, and you applied for a waiver of those penalties and interest, then there will be an automatic waiver of the same. A welcome proposal, or a welcome move, because in the recent past, there has not been any approval of the applied waivers of penalties and the interest. Now, there's also a proposal that if you had not paid the taxes until 31st December 2022, you may apply to the commissioner for a payment plan of those taxes, and that payment plan will roll over until 30th June 2024. And if you pay the taxes within that period, you will also qualify for a waiver, or you qualify the amnesty of the penalties and the interest accruing from that tax. A very welcome proposal, because the number of waiver applications that have been made with the commissioner or the cabinet secretary are too much to be dealt with at the current scenario. However, there has been a tendency of late of the government giving with one hand and taking with the other. And this is a similar scenario that will be applied in this provision. Whereas the government is allowing you waiver of the past penalties and the interest if you pay the principal tax, the government, on the other hand, has provided that room to apply for any waivers of penalties and interest will no longer be available. Additionally, the cabinet secretary or the commissioner will no longer have powers to abandon the implementation of the collection of any taxes that may prove undue, or there may be difficulties in the collection of those taxes. So, what is the implication of that? In case of an audit by the KRA, the Kenyan Revenue Authority, and there are penalties and interest that are levied on the adjustments, those penalties and interest will become payable together with the principal tax. So you can see how that interplay is coming into being, in that you are given an amnesty on one hand, and on the other hand, the government is closing the window for you to apply for future waiver of penalties and the interest of an abandonment of any taxes. We are waiting to see how that will be rolled forward, but I think the first two scenarios are quite a welcome move for many taxpayers. Moving on, there has been a tendency or a move where most tax disputes are settled through the alternative dispute resolution mechanism. However, from experience, we find that the 90 days provided for that resolution is quite limiting on many taxpayers on ADR discussions, either at the tribunal or besides the tribunal or besides the courts or the high court or the other courts. So the bill proposes to expand this timeline from 90 days to 120 days to provide taxpayers and the Kenyan Revenue Authority amicable time to resolve disputes over the ADR mechanism. In terms of refunds, there is a clarification that is being provided in the Finance Bill 2023, whereby in case you are aggrieved by a tax refund decision by the commissioner, currently there is no clear mechanism on what you're supposed to do with that refund decision you're given by the commissioner. Are you supposed to object to it, to the objections body, or are you supposed to go to the tax appeals tribunal? The bill proposes to provide that. Going forward, Any refund decision where the taxpayer is aggrieved, you appeal directly to the tax appeals tribunal. There is also a proposal to widen the scope of instances where the commissioner may issue an agency notice for any taxes that remain unpaid or uncollectible. So agency notices have been used by the KRA in the recent past to ensure that taxpayers pay their outstanding taxes or that have been due or assessed. So the bill proposes to expand this scope to include scenarios where you've defaulted on the payment of installment tax in a payment plan entered into with the commissioner. You've filed a return but not paid the resultant tax. You've been given an assessment by the commissioner, but you've not objected to that assessment within the timelines provided, or you've not lodged an appeal to the tax appeals tribunal or the High Court within the provided timelines. So this more or less provides clarity on the instances that the commissioner may issue an agency notice. There's also a proposal that taxpayers, in the event you have lodged an objection with the objection office, the commissioner has 14 days within which to validate your objection. And within the 14 days, the commissioner notifies you if your objection is valid or not. If it is not valid, the commissioner requests for certain documentation to validate the objection. The bill seeks to provide that where the commissioner has requested for additional documentation, you will now have 7 days to provide such documentation, upon the lapse of which, if you have not provided the documents, the 60 days will count from the date the objection was lodged, and the commissioner will give an objection decision. This is more providing a clarity and avoiding undue extensions of time in relation to dealing with objection decision. There is also a proposal to provide that in cases of a tax shortfall penalties, and this more or less applies to investigations by the KRA, and the KRA finds that there was a deliberate non-payment of any taxes, then the current penalty is 75% of the tax due, and there is a proposal to change this to double the tax due, or you pay 200% of the tax due to the commissioner. This mainly is more of an anti-avoidance provision and ensure strict implementation of the tax statutes and law. There is also a proposed imprisonment of people who impersonate the commissioner of 3 years for that offense. Further changes to the Tax Procedures Act will provide for the KRA will now have powers to introduce the TINS system and the e-TINS system, and there will be a penalty for non-compliance with e-TINS or TINS to the higher of Kenya shillings 1 million or the amount equal to 10 times of the amount due. You have seen previously, we have seen that any expenses that will be claimable will be those expenses that are generated over TINS or over e-TINS. So there are subsequent penalties to that have been provided in the Tax Procedures Act. In the same breath, there is also the provision of transactions that will not be subject to e-TINS. This includes imports, payments for salaries, investment allowances, and interest payments. The final changes proposed in the Tax Procedures Act entail changes to various sections of the Act. And the first one would be that withholding VAT will now be required to be remitted to the commissioner within 3 days after the deduction. Quite punitive provision from the current provision which provides for the 20th of the following month after deduction. The applicability of this will, of course, be subject to many challenges in the event that the 3 days maybe fall over a weekend or over a public holiday. There's also a proposal in the bill that any tax refunds will be made or will be refunded within 6 months from the date the commissioner ascertains that the refund is due to the taxpayer. There was also a an introduction of an exemption to the withholding VAT mechanism to certain entities that are engaged in manufacture and whose cumulative investment is at 1st July was over 3 billion shillings. So there is a proposal to repeal that provision, and which is a provision that has not been or has not seen the light of day in the implementation. There is also a very punitive provision which grants the commissioner undue powers and timelines to amend any assessments or which have been filed by the taxpayer or any assessments that the commissioner has made. So the bill provides that in case of an assessment by a taxpayer and 5 periods have lapsed, the commissioner will have another 5 years from the date the amendment was made to amend that assessment. And this really goes against the provisions in the Tax Procedures Act that provides for documents and maintenance extension period of 5 years, and the commissioner may have up to 10 years period to come and amend an assessment. There is also a provision for the KRA being given powers to establish a data management and reporting system to aid in the submission of electronic documents. This is more to ensure that there is a rollout or a complete rollout of the e-teams and the provision of documents electronically to the KRA. Finally, there is a proposal that all trustees, whether residents or non-residents, will be required to maintain and avail records required by the Kenyan or the commissioner, whether the income of that trustee is generated, is subjected to tax or not. So this is more to avoid the use of trustees to avoid payment of taxes on their distribution. So that brings to an end the changes that have been proposed in both the Income Tax Act and the Tax Procedures Act. As Michael mentioned, we'll take the questions in the Q&A platform provided in this webinar, and I wish to hand over to James Monidi to take us through the measures in the indirect taxes. Thank you once more.
Thank you, Kevin, for that elaborate step-by-step breakdown on the proposed changes that touch on the income tax as well as the tax procedures. My name is James Mulidi, and I'll be taking you through the VAT, excise duty, and miscellaneous fees and levies that are proposed in the Finance Bill 2023. And I'd also want to thank Michael for a very good preamble at the beginning, and I believe your expectations are being met as we move along. And I think Kevin has done a splendid job to try and break it down so that you can be able to understand the impact of the proposed changes in the Finance Bill 2023. So if we go straight into the proposed VAT changes, and the very first change that seems to be an error in the drafting is on matters pertaining to the applicability of VAT on petroleum products. Now, what the bill proposes is to delete the provision in the VAT Act that provides the 8% VAT rate on petroleum products. Now, what that speaks to is a direct application of VAT at 16% on petroleum products. However, if you go further down the VAT Act in the first schedule, you'll notice that Part B of that schedule still needs a cleanup, because the introductory paragraph under that Part B of the first schedule, which has a listing of the petroleum products, still makes reference to the section that has been deleted on the 8% VAT rate. But then again, there is no proposal in the bill that proposes to delete the listing of the petroleum products. So that raises the question: is the intention to increase the VAT rate from the current 8% to 16%, or is the intention to make VAT on petroleum products VAT exempt? So that is a question mark, and maybe it's a matter of a cleanup. But in essence, as a direct interpretation of that condition of the 8%, sort of automatically speaks to VAT being applicable at 16%, but we'll have to wait and see if there are further amendments by the time we get the Finance Act pertaining to the listing of the petroleum products in the first schedule of the VAT Act. Now, basically, and additionally, there is a proposal to basically subject to, basically to introduce VAT on any services that are being provided for the direct and exclusive during the construction of specialized hospitals with accommodation facilities. This basically, actually, this is a welcome proposal because you will notice in the Finance Act of 2021, there was a deletion of that, which sort of went contrary to the positive changes that came towards the health sector. And I think this is a welcome move to actually zero rate some of these services that are being provided for the construction of specialized hospitals with accommodation of more than 100 beds. Now, if we move further down, I think the discussion on the introduction of VAT on exported services over the last year has been a very hot topic. And this has rendered Kenya to be a very uncompetitive jurisdiction when it comes to service providers. And the multiplied effect of introduction of VAT on exported services is in addition to other additional taxes that would come in the form of reverse charge VAT. And you would obviously note that there's always a withholding tax that's applicable. So effectively, the introduction of the 16% VAT on exported services made Kenya a very uncompetitive jurisdiction, because then the additional taxes that are to be borne would obviously make a recipient of a service choose a different jurisdiction, which does not have an additional 16% on the services. So I think this is a welcome provision. The question is obviously the mischief here. Instead of making these exported services zero rated, they're proposing to make them exempt, obviously to run away from paying out VAT refunds as a result of any input that has been incurred by these service providers. Another welcome move is to exempt LPG from VAT, which will sort of assist in the reduction of the cost. Obviously, the debate that comes about is the claimability of any input, which will obviously be passed on as a cost to the price of LPG, because with the VAT exemption status, then it means input VAT is not claimable. However, you will notice that in an attempt, and we'll cover this in the next slide on the miscellaneous amendments, you'll notice that they're proposing to also exempt LPG from RDL and IDF. So I think that is a way to just push on the increase in the price of LPG that is now a common utility in households. Then the issue of transfer of businesses as a going concern has always has been subject to VAT over the past couple of years. So there's a proposal to exempt the transfer of business of going concern transactions from VAT. But then the biggest question that taxpayers always face is the question of interpretation of what the transfer of a business as a going concern entails. And we feel that it is better if there is some form of definition. And what taxpayers have really relied on is international best practice on what entails a transfer of business as a going concern versus transfer of assets. Then there is a proposal to exempt from VAT agricultural pest products, including inputs used in manufacture. Seems to be a welcome move to spur the agricultural sector, but then still speaks to the fact of, will the price really go down, given that there are other costs that are incurred by distributors of these products, and obviously the impact of the input VAT that cannot be claimed then will be passed on as a cost to the farmers and other consumers. Then there is also a proposal to exempt from VAT inputs or raw materials locally purchased or imported to manufacturers of fertilizers. And that sort of tries to address the issue of the cost impact that would come with the non-deductibility of any inputs that are incurred to basically manufacture these products, as well as any resultant costs associated with them. Now, when it comes to any insurance claims that are paid as a result of any loss of taxable goods, and you happen to have claimed input VAT on those taxable goods, they are proposing that you have to account for output VAT on the amount you receive from the insurance claim. But then remember, this is in the event you had claimed in input VAT on those goods that have either been destroyed or lost. Now, when it comes to the expansion of the tax rate, there's been a lot of discussion over the last 3 years on the government's intention to tap into the digital space. But what they seem to be introducing or proposing to introduce is that, remember, the VAT registration threshold is set at 5 million Kenya shillings per year on taxable supplies. But then there is an exception when it comes to digital service suppliers, where the proposal is the threshold of 5 million will not be applicable, provided you are a digital service provider. Regardless of the threshold, you are required to account for VAT, but then that will be under the simplified, basically under the simplified approach, where it's just a matter of registration, account for the output, but then there is no opportunity for these digital service providers to actually claim any input VAT. Then proposals to abolish certain VAT exemptions, and basically just quickly run through any goods that are used for the direct and exclusive construction of tourism facilities. Those exemptions that previously existed on those we create on parks of 50 acres and more, they're proposing to do away with them. Then the machinery and equipment used for plastic recycling plants, they're also proposing to do away with those exemptions. Then any capital goods that promotes the manufacturing sector, there's also a proposal to do away with those exemptions where this capital goods value exceeds more than 2 billion Kenya shillings. Then a very controversial amendment on the claimability of input VAT. And we've seen the trend over the past couple of years where there is an introduction of a requirement over and above having the necessary documentation, which basically is an ETR compliant invoice with the necessary details of the requirement of the person claiming the input to only claim the input if the output has been declared. And the question here is, number one, what jurisdiction legally do you have as a purchaser to make sure that your supplier has declared the output? But then also there is some mischief. If you look at a proposed amendment to the KRA Act, they are saying that the responsibility to provide information or be aware of information will not only be extended to the KRA, but to the general public. So you can actually see there is some mischief with this introduction where before you claim input they are proposing, you need to be sure that the suppliers claim the output, but then administratively they are saying legally, as the public, you should be aware of what is already being declared. How that is how that can be applied practically, obviously remains a question. And I think this is one of the amendments that we propose to be done away with, because it is impossible to actually be privy to the fact that output has been declared by the supplier. If we move along to excise duty proposed changes, there is a welcome move where the CS basically, the powers that he had on inflationary adjustments to be scrapped. And this sort of deviates from what happens globally when it comes to the administration of excise duty. The inflation adjustments, especially on the specific rates of excise duty, is normally applicable from jurisdiction to jurisdiction. But then I think from a Kenyan context, the challenge businesses have faced is that we've always had a cycle of at least 2 inflation adjustments every year. One that comes around in October, then it is immediately followed by a similar discourse that we're having with regards to the finance bill 2023, where there were proposals to again adjust whenever the budget was presented. So I think this is a good proposal that will push on businesses, because then there was that erratic adjustment in the inflation, and basically the excise duty rates kept going up. The inflation adjustments never seemed to go down, and it really affected the costing of products. Then there are proposed enhancements on any penalties relating to excise stamps, basically being in possession of any excise stamps that are fake, defacing the excise stamps, and any other offenses that relate to excise stamps. Then there is the issue that has already been alluded to, where the government needs the money here and now. And this actually talks to the fact that the commissioner wants the excise duty within 24 hours for betting and gaming taxes. Now, what I can talk about that fact on the betting and gaming is because there's already a platform that has been set up and that has been piloted and that has been tested, and it seems to be working for the betting companies. And this is actually supposed to onboard all betting companies to make sure that by the end of each day, any excise duty that has been basically charged on the amounts that are staked is actually remitted to the government. But then there is another proposal where the commissioner is saying that they are proposing to extend the 24-hour remittance to the other sectors. Now, that might pose a challenge compared to what has been implemented for the betting and gaming, because a framework already exists. So how this will be done for the other sectors, and remember, excise duty now is applicable on literally everything. So there are certain items we are struggling to see how the government will be able to implement the remittance of excise duty within 24 hours. When it comes to the digital lenders, I think that is another space that has grown. They are proposing to basically expand the amounts that are subjected to excise duty. The current provisions provide that any fees that are paid to digital lenders are subject to excise duty, but they are proposing to change the wording to say any amount that is payable to the lender. So it's basically just to widen the scope. On the issue of applicability of excise duty on plastic containers, I think this has been a very controversial issue over the past year. And it's because the amendment through the Finance Act 2022 was very clear that excise duty is only applicable on imported plastic articles of tariff heading 39. But here I had a different view, despite the fact that the law was clearly drafted and the recordings of the Hansard were clear that the intention of introduction of the excise duty on plastic articles was only to cover for imported items. This seems to be, do I really call it a cleanup, because the current law already talks of imported plastic items. So I think it's just a clarification on that issue. I think this should actually dispense that matter going forward for manufacturers of plastic containers. Then on excise applicability on items that contain cocoa, it sort of suggests that any item, any food preparation, any food supplement that has cocoa in it, and including luxurious confectionaries like chocolates, whether they are imported or manufactured locally, might be subject to excise duty, which obviously increases the price. Then there is the introduction of excise duty on imported fish, sugar, powdered juice, and for the ladies, unfortunately, you've got to cough a little bit more when it comes to the wigs and human hair, artificial nails. And this is basically just intended to increase the collections of excise duty. Then there are proposed increase in excise duty rates on betting and gaming activities from the current 7.5 to 20%. And this raises the question about basically the future of these betting companies, because then the cumulative taxes, and as Kevin also indicated, winnings is purely being now defined only to relate to the amounts that have been placed as bets. And there is a withholding tax on it. There is an increase in the excise duty, so it actually looks for the low value bets it will basically be an offset to the punter when they place these bets. Then any advertising relating to alcohol, betting and gaming activities will now be subject to excise duty. Then there are basically the suspension of licenses for excise purposes has been enhanced in case of contravention of the excise rules. If we move on to the miscellaneous fees and levies, the proposed changes is to introduce something very peculiar. And Kevin alluded to the fact that the government is giving on one hand and taking on the other. And if we quickly brush through the bullets, you'll notice that there is a proposal to introduce what they're calling an export and investment promotion levy on specific goods that are listed in the third schedule of the Miscellaneous Fees and Levies Act at a rate of 10% of the customs value. So there is an additional levy that will come in, assuming this proposal is sustained. But then if you look at bullets 3 and 4, they are proposing to reduce the IDF and RDL fees. So it could be a step of one step forward, then 2 steps back. So I think the impact of that needs to be assessed, because then I don't think it's the reduction of IDL and RDL and IDF will actually give reprieve to importers when there is another introduction of another levy at the rate of 10%. Then there is a proposal to exempt IDF and RDL to KDF and the National Police Service, basically just to expand the items that qualify for IDF and RDL exemption. That the proposed IDF and RDL exemptions as well on aircraft and LPG and any imports by international organizations. Then the preferential IDF and RDL of 1.5% that was applicable to manufacturers upon approval has been scrapped. Then there are further proposed changes to the export levy rates on certain goods. You'll notice that there are certain goods that the government encourages to be used locally for production. And a good example is high-tech skills. And I think the companies that have existed, the likes of Bata Shoe Company, have always thrived on the fact that there is a local supply of hides and skins. And they find that these products are normally subjected to an export levy just to discourage exportation of these products. There are certain proposed changes to the levy rates. Some have gone up, some have gone down. And some of these proposed amendments have been informed by how different industries work. Then there is a proposed introduction of the National Housing Development Fund at the rate of 3%. These are the impacts to employees, because in addition to, for example, the super fund of 35% that will eat into disposable income, we're looking at an additional 3% on the housing fund that will be deducted. And you must have seen the proposals to increase the NHIF rates. So you can actually see the impact that will be there when it comes to disposable income. Now, from a tax appeals point of view, and this is something Michael expounded on as he was making his opening remarks, is this issue of denying taxpayers justice when it comes to any appeals to the High Court. And the question is, the tax is already in dispute. Why are you being required to make a deposit before you can appeal your matter to the High Court? So it's basically a matter of fair administration and justice. Historically, in the last budget cycle, Finance Bill 2022 had a similar proposal. And this proposal was even before you make your appeal to the Tax Appeals Tribunal, and the rate was even higher at 50%. Sometime back in 2014, there was a similar proposal in the bill. But I think we can look at the trend. The trend has always been the government wants to provoke in the bill, but then nothing materializes when the act comes through. So I think this is another area that needs to be looked at, because every taxpayer is entitled to justice when it comes to tax disputes. Now, on matters that you can appeal at the Tax Appeals Tribunal, there has been a definition of what an appealable decision is. And an appealable decision does not include an unfavorable decision pertaining to a refund application. So for refund application, that assuming you made a tax refund and it was rejected, you now have to go and appeal the matter directly to the tax appeals tribunal, which in my view does not make sense. Because a lot of refunds that are rejected are purely as a result of documentation. KRA will always say they've not received the documents, they've not ascertained the refund. I don't know why such an issue should go to the tribunal. I think the tribunal should be more invested in matters of law as opposed to matters of fact. Then there is another welcome provision. By the time you're making any appeal to the tax appeals tribunal, then you are allowed to introduce any additional documents that support the grounds for your appeal and the grounds that you used for your objection. So basically, any documents that will reinforce your grounds for appeal can be introduced when you're making your appeal to the tax appeals tribunal. And with that, I come to the end of the proposed changes on excise duty, VAT, as well as the tax appeals mechanism. Thank you for your time, and I'm now handing it over to the next presenter, Mr. Salim Alibai.
Yeah, thank you very much, James. Thank you once again, everybody, and welcome to the miscellaneous changes that are contained in the Finance Bill 2023. Of course, there are very few changes at the moment, but we do expect that once the Cabinet Secretary reads the entire budget speech, there will be more matters to be discussed. A little bit of more meat will be added to these particular things. The key changes that come out from this particular finance bill are one on the Kenya Roads Board Act. Previously, there was no requirement to submit documentation on the annual revenue estimates as well as budget estimates are being submitted to the Cabinet Secretary for approval. That has now been made mandatory by this particular bill if it goes through. Again, the bill obviously aims to expand the amount of transparency that is actually required by government before they actually incur any sort of expenditure. The Kenya Revenue Authority Act has also been changed, whereby there will be an institution that can be established by the Kenya Revenue Authority to provide training either to the general public or to other jurisdictions, or to its offices itself. Again, this is a welcome move because there will be a lot of information sharing that will come across different jurisdictions, and other jurisdictions will also be able to understand a little bit better what KRA requires or what the various tax provisions require for free flow of information. And this also supports the common reporting standard that came up a couple of years ago. There has been a change in the Statutory Instruments Act, whereby there will be the automatic revocation of statutory instruments, which has a 10-year limit, will now no longer be the case, and that will continue to perpetuity unless any other act requires that particular provision to be removed. On the Unclaimed Financial Assets Act, designated claimants, for example, those who are beneficiaries of a particular will now be able to make direct claims to the Unclaimed Financial Assets Authority. Previously, the Act did not allow for this, and that basically means that in the event that somebody passes on and leaves their estate, which had a particular number of assets sitting with the UFAA, those can now be claimed directly with the claimants. A couple of changes on the retirement benefits, which is the Deputy President and Designated State Officers Act have been proposed, which include, of course, one of them, which is a very welcome move, that in the event that there are duplicate benefits being paid to any government officer, that is now going to be removed, for example, on people who previously held a government position and now hold a government position and are actually getting a state pension because of their previous position, and also get something because of the current position that will be actually looked at, and one of the provisions will be removed. There is also talk about provision of pension benefits to entitled persons under the Parliamentary Provisions Act. Again, we wait for more clarification on this. And the last one being that there would be additional benefits being looked at if the bill went through for the retired Speaker and the clerk of the National Assembly, as well as the Senate. Thank you very much. I will now hand over back to Michael to take us through any questions that may be asked as part of this webinar?
Thank you very much, Salim, James, and Kevin. You've done a sterling job as always. And, I think this weekend I owe you something for the evening on Friday. So thank you very much. Ladies and gentlemen, we are coming to the tail end of this presentation. Happy to let you know that we had more than 700 people participating in this webinar. We have an avalanche of questions and we will not be able to pick each and every one of them. What I encourage you to do is to pick the contacts of the gentlemen on the screen over there. You can channel your question to us via email. We will respond to you if we don't have a chance to respond to it in this webinar. So thank you very much for being with us. And definitely, I'm sure you have picked some very nice positive developments proposed in the bill. Some have made you a ritual announcement for the ladies. Happy to let you know now that you don't have to give your P9 and payslip to your husbands. You can go ahead and file your returns independently. That is empowerment. For automatic waiver of penalties and interests on principal taxes that have been settled by 31st of December 22. That's a very good development because I do personally have waiver applications I have submitted for clients that have been sitting with the National Treasury for the last 10 years. This looks like a very, very good proposal, quite as it is, in terms of really cleaning the past, that the commissioner is now actually going to refrain from ever claiming that penalty and interest. If at all, when you launch the application for waiver, you are paying a principal tax, and that was a requirement that you pay the principal tax before launching any application for waiver. That's a really positive development, including the application that now can go to the commissioner, where you have not paid principal taxes by 31st of December 2022, is actually very positive in the sense that it will, first of all, help the government to net in some tax revenues. I am certain that that waiver is going to be not exactly 100%, it's going to be negotiated based on the grounds that you give for the appeal. And it is also going to help people to clean up the past. The unfortunate bit is that for any penalties and interest you accrue from 1st of January 2023, the commissioner has been denied the power to abandon the tax or to waive the penalties or interest. In the recent past, we have seen the Kenyan Revenue Authority challenge abandonments and waivers that were granted in the past, and those matters have now proceeded, some of them to the High Court. We are yet to see how that is going to be resolved. So there has been very significant good changes on one side. Some you would say moderate, and others would make people unhappy, especially people in the middle class. But just know that in the end, it calls for patriotism to support your country in terms of footing it bills to be able to provide you with security, to be able to provide you with the roads, and everything that government is ought to do to you. It's also your responsibility to question government when they don't live up to that task. So I'll straight away go to the questions, and I'll start with Kevin. As I said, we have received an avalanche of questions from you people. We may not be able to answer each and every one of them, but we will attempt for those that we can, and for those that we can't, again, reach out to us. So Kevin, the first question is on EBITDA, and this is from a participant who wants to know if a company has a local loan on which interest is already 30% of EBITDA, and we also have a foreign loan, interest to the extent of an additional 20% EBITDA. Will the company get overall deduction for all the interest, as this capping is not for domestic loans? To you, Kevin.
Thank you, Michael, for that question. Definitely, I expected questions, reactions, and so forth from that provision. Now, currently, as the income tax rate is that if you have interest that exceeds 30% of your EBITDA, and that interest is from both local and foreign loans, you are allowed to restrict, or you are supposed to restrict that interest to the extent of 30% EBITDA. So you claim it is capped at 30% EBITDA. What does the bill propose? The bill proposes that going forward, the only interest to be considered in looking at that 30% EBITDA threshold would be the interest applicable on foreign loans only, whether those loans are from related parties or from that parties that are non-resident. I hope that clarifies the question.
Thank you for that, Kevin. And you have another related question to that. And the question is, are loans from local banks in foreign currency, USD, pounds, or whatever it is, classified as local loans, or are they classified as foreign loans? Do you care?
Thank you, Michael. I think the definition of resident and non-resident is clear in the Act, and unlike non-resident, it means any person who exists outside the jurisdiction of Kenya or any entity in a preferential tax regime. And maybe just to clarify on that is that the loans to be considered would be those loans from non-resident persons. So any loans from local companies, whether in the local currency or in foreign currency, are all considered local loans and will not be considered in that strict restriction provision. Just another clarification on the same is that once you restrict that interest in year one, you are allowed to claim that interest for a period of 3 subsequent years. But before you go and claim that interest in any of those 3 years, you have to check in each of that year, have you breached the 30% EBITDA rule? So if you find a scenario where the interest payable does not exceed the 30% EBITDA rule, maybe your EBITDA performance has improved, you are allowed to go in the previous year, take a chunk of what you disallowed, you can and claim it in the subsequent year to the extent that you don't exceed 30% of EBITDA.
Thank you, Kevin. I'll give you a break to sip some water and I'll come to you, James. I'll be invested in Kevin for more questions. James, one participant would like to know whether there are any particular changes in respect of pharmaceutical industry. Anything that you think at the top of your mind, James?
Yeah, so for the pharmaceutical industry, there are proposals to just reclassify a number of pharmaceutical products as per the first schedule to either make them vatable or exempt. But I think details of that will be contained in our alert, in our detailed alert on those amendments from a VAT point of view that touch on the pharmaceutical industry.
Yes, and of course, James, on that is the manufacturers of human vaccine. The tax rate prescribed for them is preferential at 10%, and with a lot of other incentives. And certainly, this is in the background of the recent visit by the American Chamber of Commerce, and we saw the Americans announce that they will be setting up a huge vaccine manufacturing factory at Taxation. Another question, James, to you is that in respect of proposed 15% relief on contributions known as post-retirement medical fund, has any criteria been outlined as to what type of fund will merit or qualify for that kind of relief? Is this going to be entirely down to KRA to decide at what time? So I reckon the question, James, is about, do we require detailed regulations to govern post-retirement medical fund that is anticipated in law? Is it practical as proposed in the bill to implement?
Definitely, Michael. We will require regulations. As the proposal is currently drafted, it just gives an overall proposed introduction of a relief, which sort of follows the same insurance relief that you would get, which is basically 15% of gross up to a maximum of 60,000 shillings per year. So we obviously will expect regulations on what sort of medical schemes can be taken up. But as is currently drafted, it just gives the overall intention of a relief, especially during the post-retirement phase. but then regulation will have to be gazetted, basically, just to clarify, assuming this proposal is retained.
Thank you, James. Sarim, I come over to you. And the question for you, you had one slide, quite brief. And the question is there any change to the applicability of the Unclaimed Financial Assets Act? And could you clarify the scope? Is it limited to financial institutions? Salim, what do you have to say about that?
Sure. Yeah, thank you, Michael. If you look at the previous budget speech that was read and the changes to the Unclaimed Financial Assets Act, it brought actually into definition a lot of the other financial assets, which included unclaimed wages, which are held by non-financial institutions, for example, as well as any sort of deposits issued by customers to you. Of course, that is based on other statutory limitations. Again, each particular circumstance will be different. And what I would say for now is that the best thing to do is to get a legal opinion on this particular matter, because there could be some instances whereby we do need to remit funds to the Unclaimed Financial Assets Authority. If not done, of course, the UFAA has already started undertaking a lot of compliance audits on a lot of institutions, which include non-financial institutions as well. And of course, because of that, they would levy penalties for any sort of non-compliance. So as of now, I'd like to say the best thing to do is to get a legal opinion based on each particular circumstance. But yes, they do include non-financial institutions, as well as not only financial liabilities, but other sorts of liabilities as well, which need to be remitted based on certain statute.
Thank you very much, Salim. Kevin, I come back to you with a question on capital gains tax. And this is the question: if a property was inherited from your father or your parents, and if subsequent transfers have happened before 5 years, what will be the cost? What will be the value? Is it the value that the father bought the property, or zero value, which was value transferred from the father to the child? That is the anti-avoidance introduction, and how does it relate to this very specific question?
Thank you, Michael. Just to brief about it is that currently, how the Act is under the 8th schedule. If you have a transfer from or within family members, which is exempt from CGT, then you go ahead and do a subsequent, so like that scenario, the father transfers to the son at zero value. Then the son goes ahead and declares that property or sells it within a period of after 3 years. Then you will have avoided the anti-avoidance provision under section 23. So what people are doing is that you transfer an asset in an exempt transaction, hold on to 3 years, then transfer it to ensure that it does not get into the net of anti-avoidance provision. So what the new bill proposes is that if there is a subsequent transfer after a period of not less than 5 years or not more than 5 years, then the original value will not be the value from the father to the son, which is zero. The transfer, the adjusted cost will not be the value from the son from the father to the son, which is zero. The adjusted cost will be the original price that the father bought the property at.
Thank you, Kevin, for that. And over to you, James. This is a very interesting question, James. What value, what advice would you give to clients who are VAT due on export services prior to June 2023, which may not have been declared or paid, especially in light of VAT exemption on the same under the new finance bill? And I think the question there, James, is what is the effective date of this proposal?
So basically, this proposal, assuming it is sustained, will have an effective date of 1st of July 2023. But just to address that issue of the unclaimed credits, you will notice that there has been changes over the last two finance acts pertaining to exported services. Remember, for the period prior to 1st of July 2021, all exported services were zero rated. And taxpayers who had any excess input VAT within the law are required to file any refund claims with the KRA. Now, and you will notice there's been a lot of litigation pertaining to the refunds for input VAT from exported services. Now, and the KRA unfortunately lost all those matters, and these cases are in the public domain. And this is what necessitated the change of the VAT status of exported services from zero rated to exempt, with effect from 1st of July 2021. Now, the Finance Act 2022, which was, if this particular change was effective from 1st of July 2022, exempted VAT on exported services. And basically, this was just to cure the fact that they have lost all these cases, which are still being litigated. Some have actually even been determined by the Court of Appeal. So basically, this was their cure against the refund claims by exporters of services. And that's why they exempted it for the period from 1st of July. So basically what it meant, for any claims that you had given the precedents that had been set within the set timelines of 12 months, you should have made the refund application. For the intervening period between July, 1st of July 2022 till 30th of June of 2023, you didn't have the opportunity to claim any input because they were VAT exempt. Anyway. Then there was the issue that came with the introduction now of the VAT, which is what we have been arguing, and the questions have been coming in. Should we be charging VAT from 1st of July 2022 or not? Are the exported services BPO in nature? And remember the facts that I alluded to, that their competitiveness that the introduction of VAT brought in. And this proposed amendment is basically to arrest that situation where there was a lot of flight of service providers to other jurisdictions as opposed to Kenya. So the effective date of this, if it is sustained, should be from 1st of July 2023.
Thank you, James. And very last question to you. And I can see this is from a participant who is already doing very aggressive tax planning. And the question is there any penalty for not remitting VAT within the 24-hour rule or the 3-day rule?
A very good question. And I will point the question to what does the law say. Now, if you look at the 24-hour and the 3 days remittance rule that is proposed, it is on VAT, that is from a withholding VAT perspective and an excise duty point of view. And legally, the timelines within which this tax is due is by the 20th of the subsequent month. Now, when we say 20th of the following month, we do not mean that you have to wait until the 20th to pay the tax. You can pay it earlier, so it is on or before. What the proposal seems to be suggesting is to deviate from that legally set time frame of an additional 20 days in the next month to make sure you remit, and whether do it within 24 hours or 3 hours. So are we looking potentially at further adjustments, assuming the 24-hour and 3-day rule is maintained, where they will do away with by the 20th of the following month? Because if by the 20th of the following month timeline is retained, why should you be penalized yet the law gives you that leeway for that duration of time? So I think it's just a matter of, will the law be further amended to go away with the 20 days and restrict it to the 24 and 3 hour? Obviously, any delay beyond the timelines prescribed will attract the penalties and interest as prescribed in law. Thank you.
Kevin, one last question to you. And this question has come across from many of you participants. You are concerned about expenditure claims and for income tax purposes. And the new requirement is that it must be supported by teachings. Please expound on this. And does this only affect income tax or both VAT? how does this relate the fact that the VAT Act 2013 only requires registration for people who have hit the threshold of 5 million shillings? And of course, a lot of people in the informal sector are not within the VAT net. How will these expenses be treated, Kevin?
Thank you, Michael. When it comes to eating, so the proposal is that no expense will be allowed or loss in a year of income if that expense or loss did not arise from an invoice that is eating compliant. Now, I knew there would be very many queries on the same, to the extent that what does eating's registration requirement pertain to? Now, we need to separate two items here. There is a VAT registration requirement. That is where you have met the threshold of 5 million shillings of taxable supplies, or if you've not met that threshold, then you register under the voluntary registration framework. That registration is what is pegged currently to the TIMS device, and the TIMS device is used to generate tax compliant or VAT compliant invoices. Now, if you look at the rollout and implementation of eTIMS, eTIMS is more of a data management system that will require all invoices that are generated, whether you are VAT registered or not, to be delayed real-time basis to the commissioner. So eTIMS, those invoices that are eTIMS compliant do not require to be VAT generated invoices. It can be even invoices that are generated by non-registered VAT persons, but to the extent that that invoice has to be generated over eTIMS. I hope that clarifies the concern, Mike.
Thank you, Kevin. And just before I bring to a close this discussion, to be fair to you, Salim, I have a question for you. Sure. If you are the Minister for the National Treasury, what is it that you would do in terms of taxes to be able to finance the 3.6 trillion budget, away from these proposals that are in the bill? Because it is very easy to criticize what the government wants to do. What is that Salim, Cabinet Minister Salim, would do to get the money differently? The one thing you do.
Well, over and above what is already been proposed, I think one of the things that needs to be done is to try and widen the tax net itself. Because I believe that the level of tax compliance in this country is not exactly where we want it to be, although it has been improving with time. If you will see from the number of tax proposals that come through each and every year, there has been a significant uplift on this particular matter. The second thing that needs to be critically looked at is on government spending. There seem to be a lot of projects that are sometimes not very carefully thought through, in my view. And I think we now need to give priority to only those projects that are going to be either absolutely necessary, for example, the infrastructure projects, or those that will actually generate income for us. Because this comes to us at a time when our budget deficit keeps on increasing year by year, and the situation will not get any better, considering that we already do have a significant amount of loans to be paid in the near future, and the exchange is not helping us very much, because our currency seems to be sliding against the major currencies like the US dollar, and our loans are actually denominated in that. So I think widening of the tax net, in summary, and also prioritizing on the projects that need to be done by government is what I would actually say my key focus areas would be, if I was in that seat.
Thank you, Salim. One day you will get there. So thank you very much, everybody, for participating in this webinar. We've come to the end. I truly want to thank the presenters, Salim, Kevin, and James, and the entire PKF team that has supported us to be able to make this happen today. Very shortly, we will be circulating to you our very detailed tax alert. This was our very big finance bill, close to 140 pages. We've taken time to analyze. We will be sending our alert to you, very detailed, If you are not in our mailing list, feel very free to get in touch with any one of the people listed on the slide that you are facing, and we will be able to put you in our database and to forward this alert to you. Again, thank you very much, and you have a good day. Thank you.